Something enormous is shifting beneath the global financial system right now, and almost nobody is talking about it out loud. Not because it is not happening, but because it is happening quietly, methodically, behind closed doors, in policy rooms and central banks and trade agreements that never make headlines. The world you wake up in every morning still feels familiar. Dollars still work. Markets still open. Stores are still stocked. But history teaches us something uncomfortable. The most important monetary collapses never announce themselves with sirens. They arrive politely. They arrive slowly. And then all at once. There is a reason empires rarely recognize their own turning points. When you live inside power, it feels permanent. It feels structural. It feels like gravity. But power built on money is fragile in ways most people never see, because money itself is a story, a shared belief, a collective agreement that only holds as long as everyone keeps believing it. And once that belief starts to fracture, even slightly, the unraveling can move faster than anyone expects. More than half a century ago, another global superpower learned this lesson the hard way. At the time, no one believed it could happen to them either. They had ruled global trade. Their currency had been the backbone of the international system. Their navy controlled the seas. Their flag flew across continents. And yet their fall did not begin with war or invasion. It began with debt, denial, and the quiet arrogance of assuming tomorrow would look like yesterday. To understand what is unfolding now, you have to understand how global money actually works. A reserve currency is not powerful because of patriotism or prestige. It is powerful because other nations choose to use it. They price trade in it. They store their savings in it. They trust that it will hold value tomorrow. That trust allows the issuing country to do something extraordinary. It allows them to spend more than they earn, year after year, while the rest of the world absorbs the cost. For decades, the United States has lived inside that privilege. The dollar became the center of global finance after the Second World War. Oil was priced in dollars. Trade was settled in dollars. Debt was issued in dollars. Foreign central banks accumulated dollars and United States Treasury bonds as reserves. This created an enormous advantage. America could import far more than it exported. It could run massive deficits without immediate consequences. It could finance wars, social programs, and crises by issuing debt that the world eagerly bought. But privilege has a cost that only shows up later. When a country realizes it can borrow endlessly, discipline slowly erodes. Spending becomes easier than reform. Promises become easier than production. Political pain is postponed, again and again, until the math becomes impossible to ignore. This is where the quiet part begins. For years now, the United States has been adding trillions to its national debt at a pace that would have been unthinkable to previous generations. Interest payments alone are swelling toward levels that rival the entire defense budget. Not because of a sudden emergency, but because the system itself now requires constant borrowing just to function. The government is no longer borrowing to invest. It is borrowing to stand still. And while this is happening, something else is changing in the background. Other countries are slowly, deliberately reducing their dependence on the dollar. Not dramatically, not loudly, quietly. Bilateral trade agreements are being rewritten. Alternative payment systems are being tested. Gold reserves are being accumulated at the fastest pace in decades. Entire trade blocs are experimenting with settling transactions without touching the dollar at all. This is not a rebellion. It is a hedge. When trust starts to wobble, rational actors prepare exits. They do not announce them. They do not make speeches. They simply reduce exposure. And once that process begins, it rarely reverses. History gives us a near-perfect mirror for this moment. In the early 20th century, the British pound sat where the dollar sits today. It was the world's primary reserve currency. Global trade depended on it. Financial markets revolved around it. Britain could borrow cheaply, spend freely, and maintain a vast global presence because the world believed in the pound. But beneath the surface, the foundation was eroding. Industrial dominance had slipped away. Productivity lagged. Debt piled up. 2 world wars accelerated the damage. Still, Britain refused to adjust. Leaders clung to prestige. They clung to empire. They clung to the idea that reputation could substitute for economic reality. For decades, the illusion held. Then one moment exposed everything. In the mid-1950s, Britain attempted to assert its old authority during a geopolitical crisis involving a vital trade route. Militarily, the operation was competent. Politically, it was disastrous. The United States, now the true financial center of the world, opposed the move. Instead of sending troops, it applied pressure where it hurt most: money. American officials signaled they would sell large amounts of British currency and block emergency financial assistance. The effect was immediate. The pound came under attack. Reserves drained rapidly. The British government realized it was days away from financial collapse. Food imports, fuel supplies, and basic stability were suddenly at risk. Within days, Britain backed down. Not because it lost a battle, but because it lost financial credibility. That moment marked the psychological end of British global dominance. The world saw clearly what had already been true for years. Britain was no longer in control of its destiny. Its power depended on the tolerance of its creditors. This is the part few people want to talk about today, because the structure now looks uncomfortably familiar. The United States currently maintains hundreds of military installations across the globe. It guarantees security for allies. It enforces financial rules. It acts as lender of last resort during crisis. All of this costs enormous amounts of money, and almost all of it is financed through debt. At the same time, manufacturing capacity has hollowed out. Supply chains stretch across oceans. Consumption vastly exceeds production, and yet the system keeps running because the dollar remains central. But centrality is not permanent. It is conditional. What happens when major trading nations decide they no longer want to hold endless dollar reserves? What happens when energy deals start settling in other currencies? What happens when digital payment rails bypass traditional systems entirely? What happens when confidence erodes just enough that investors demand higher interest to hold government debt? The danger is not collapse overnight. The danger is a slow tightening spiral. Higher interest means higher debt servicing. Higher debt servicing means more borrowing. More borrowing means more doubt. More doubt means higher interest, and the cycle feeds itself. This is how monetary empires unwind. Quietly at first, then all at once. And here is the uncomfortable truth most people miss. The global reset everyone whispers about is not a single event. It is not a button that gets pressed. It is a process already underway. It happens through policy shifts, trade realignments, reserve adjustments, and confidence erosion that only becomes obvious in hindsight. By the time the average person realizes something fundamental has changed, the change is already irreversible. The unsettling part is not that change is coming. Change is constant. The unsettling part is that the signs today look eerily similar to those that preceded every major monetary transition in history: excessive debt, political paralysis, overextension, moral certainty mixed with financial fragility, and a widespread belief that this time is different. It never is. And the deeper we go, the clearer the pattern becomes, because the same forces that ended past monetary eras are quietly aligning again, right now, beneath the surface of the global economy, waiting for the moment when belief finally gives way to reality. What makes this moment especially dangerous is that most people are still looking in the wrong direction. They are watching stock prices, election cycles, headlines, personalities, but monetary shifts do not announce themselves through drama. They move through plumbing, through settlement systems, through reserve ratios, through trade contracts written in quiet rooms by people you will never see on television. By the time the headlines catch up, the outcome is already locked in. The illusion of stability is powerful because it feels normal. You wake up, swipe a card, numbers move on a screen, and life continues. That normality creates a psychological trap. It trains the mind to assume continuity. But history does not operate on feelings. It operates on constraints. And right now, the constraints are tightening. One of the most misunderstood ideas in modern economics is that reserve currency status is a reward. It is not. It is a responsibility that slowly turns into a burden. When the world needs your currency, you must supply it. And the only way to supply it is to run deficits. You must import more than you export. You must send your currency abroad in exchange for real goods. Over time, your industrial base shrinks while consumption grows. Living standards feel high, but the foundation underneath them thins out. This is exactly what happened before. The earlier empire watched its factories close while finance expanded. It watched trade deficits grow while its currency remained strong. It mistook financial dominance for productive strength. And when the moment came that confidence cracked, there was nothing underneath to catch the fall. That same dynamic is now playing out again, only on a larger scale. The United States has not run a trade surplus in decades. Entire categories of manufacturing have vanished. Supply chains stretch across continents. Essential goods depend on geopolitical rivals. At the same time, the financial sector has grown massive, complex, and deeply intertwined with government borrowing. The system survives because confidence persists, because foreign buyers continue to purchase government debt, because markets assume stability tomorrow will resemble stability today. But confidence is not a law of nature. It is a collective decision that can change. When trust begins to weaken, the first sign is usually subtle. Central banks diversify reserves, not abandon diversify. Trade agreements quietly include alternative settlement options. Commodity producers accept multiple currencies. None of this triggers panic, it looks like prudence. And that is exactly how transitions begin. Over time, these small decisions accumulate. Demand for the dominant currency softens. Interest rates drift upward to attract buyers. Debt servicing costs rise. Fiscal pressure increases. Political tension grows as leaders promise benefits without explaining costs. And slowly, almost invisibly, the margin for error disappears. At that point, any shock becomes dangerous. A financial crisis, a geopolitical confrontation, a failed bond auction, a sudden loss of confidence. Something that under normal conditions would be manageable becomes catalytic. The system does not collapse because of the shock itself, but because it no longer has the flexibility to absorb it. This is what people misunderstand when they imagine collapse as chaos. Collapse, in monetary terms, often looks bureaucratic. It looks like emergency meetings, emergency lending facilities, temporary measures that quietly become permanent, new rules justified as stabilizing tools, controls framed as protections. And then, one day, people realize that their money does not buy what it used to, that their savings do not stretch as far, that their wages lag behind prices, that stability has thinned into fragility. When this happened before, ordinary citizens did not wake up one morning to headlines announcing the end. They felt it in smaller ways first. Imported goods became more expensive. Travel became harder. Living standards slipped. Confidence faded. And only later did history assign a date to the moment everything changed. The uncomfortable truth is that reserve currency transitions do not end with a bang. They end with a long, grinding adjustment that reshapes society. This is why the phrase, global reset, is so misleading. It implies a single coordinated event. Reality is messier. It is a drawn-out recalibration where power, influence, and purchasing power slowly migrate elsewhere. Some institutions adapt. Others resist. Many fail. And resistance, ironically, often accelerates the outcome. When leaders deny reality, they double down on appearances. They borrow more. They promise more. They spend to preserve the image of strength. This buys time, but it increases fragility. The eventual adjustment becomes harsher because the underlying imbalance grows larger. History is brutally consistent on this point. Empires do not fall because they are attacked. They fall because they refuse to adapt. What makes the present moment so striking is how closely the patterns align. Rising debt, political polarization, overextended commitments, faith in exceptionalism, a belief that the rules somehow do not apply anymore. All of it echoes previous transitions with unsettling precision. And yet, there is nothing inevitable about catastrophe. There is only inevitability in denial. The purpose of understanding this is not fear, it is clarity. Because individuals who understand structural change early have options. They can think long-term. They can diversify. They can focus on resilience rather than speculation. They can build skills, savings, and flexibility rather than assuming systems will always function as they have. When previous monetary orders faded, the people who suffered most were those who believed stability was guaranteed. The people who adapted were those who understood that systems evolve. This is the part rarely discussed. Monetary transitions do not destroy everything. They reorder incentives. They change who wins and who loses. They shift which skills are valuable and which assumptions become obsolete. They punish rigidity and reward adaptability. The global system is not ending. It is rebalancing. But rebalancing feels violent to those positioned on the old center. As confidence in a dominant currency softens, alternatives gain space. Regional trade increases. Bilateral agreements multiply. digital settlement systems mature, asset preferences shift. None of this happens overnight. But once momentum builds, reversal becomes difficult. And here is where the story circles back to the present moment. We are living inside the early chapters of that transition. The signs are visible for anyone willing to look beyond headlines. Debt trajectories that cannot continue indefinitely. Interest burdens rising faster than growth. Political systems unable to make long-term trade-offs. A global environment where trust is fragmenting into blocks. The danger is not tomorrow. The danger is complacency. Because when the tipping point finally arrives, it will feel sudden. It will feel unfair. It will feel like it came out of nowhere. But in truth, it will have been building for years. This is why history matters. Not as nostalgia, but as a diagnostic tool. Patterns repeat because human behavior repeats. Pride, denial, overconfidence, and short-term thinking are not new. They are constants. The earlier empire believed its status would protect it. It believed that past glory guaranteed future influence. It believed that the world needed it more than it needed the world. Those beliefs delayed adaptation until adaptation was no longer possible. Today, similar beliefs circulate under different language. That innovation will always save us. That growth will solve everything. That markets will self-correct. That leadership will figure it out in time. Maybe they will. But history suggests otherwise. What history shows, again and again, is that transitions favor those who prepare quietly rather than those who argue loudly. Those who study structure rather than headlines. Those who understand that money is not wealth, but a claim on it. The global monetary system is not collapsing. It is evolving. But evolution is not gentle. It selects. And this is the moment when awareness matters most. Not panic, not prophecy, awareness. Because once confidence finally shifts, once trust finally rebalances, once the center of gravity moves, there is no announcement. There is no countdown. There is only a realization, in hindsight, that the world you assumed was permanent had already begun to change. The reset does not arrive with a single date circled on a calendar. It arrives through a series of quiet decisions that, taken together, rewrite the rules. And by the time most people notice, the rules have already changed. That is why this moment matters. Not because collapse is guaranteed, but because transition is underway. The question is not whether the global system will look different in the coming years. It will. The real question is whether you will understand what is happening as it unfolds, or whether you will only understand it after it is over. History never repeats exactly, but it always leaves clues. And right now, those clues are everywhere, hiding in plain sight, waiting for those willing to see them.